All right, guys. So in the last video, we touched on the return on investment, and like I said, it applies to everything. But I guess in this video, we're gonna touch on the real estate, and we're gonna just delve right into it. Investment properties, as far as that goes, because I really love this topic altogether, and we're gonna touch on a couple of different markets and see what makes sense and what doesn't make sense. A lot of different bloggers and video, people, YouTube people, they're gonna mention all kind of formulas and everything that you have to go through in order to decide whether it's a good investment property, whether it's not. It's pretty simple math, guys. It doesn't have to be that complicated. A lot of times, it doesn't have to be very complicated at all. All right, guys. So let's look at this property right here in the hot area of Los Angeles, California, which exploded in the market value over the last 10 years. If you're lucky, if you bought something, even especially on an onset of recession back when we had it in 2008, if you ever bought anything like that, that's just guaranteed you're gonna make some money on it. And it seems to be slowing down in that market, and a lot of those hot markets are slowing down. But somebody bought this property for $840,000. Now the appreciation from last year, February of last year is when they bought it. The appreciation quite seems to be significant. So you're gonna make money on that, given, of course. But let's look at the actual concrete numbers of somebody's paying on a note on this property. So let's look at $5,500 is what you would be paying on this property. So that includes, of course, insurance, taxes, and your primary principal and interest payments. PITI is what they call it. So that's what your payment is going to be, $5,500. Rental income, I looked closely, just glanced over it, about $2,000, maybe $2,500 a month. It's what the rental income is going to be on that property. So maximum you're going to receive on a property is $5,000. $5,000. Let's look at it that way. So let's say we ignore everything, and your tenant, for some reason or the other, is paying utilities, they're paying for your maintenance, they're paying for your everything, right? Let's look at it that way. So even that wonderful scenario, which is never going to happen, you are losing $500, $557. You're losing on that property. It makes no sense. It makes absolutely no sense. Now, yeah, there's appreciation that has been happening, and there's been a bull market in that market. In that particular market, has been a bull market for the past 15 years, almost 15 years. So great if you have some appreciation from that, because it was a no-brainer back when just to purchase that property, because you guaranteed to have that go up in value, guaranteed. Now we have a different, we have a change where those markets are slowing down and possibly even actually dropping in price. So if you buy that kind of property, maybe you're going to lose on it, and you're definitely going to lose on rental income. So let's look at it this way: you put in $840,000, so you're mathematically, let's say you have a 75 LTV, loan to value, on this property. So that means 25% of that was supposed to be cash. So that's about a quarter. That means $210,000. $210,000 is what you have to come up with in cash on a 75 LTV on this property. So you basically invested $210,000 cash on this property, and you're losing $500 a month on this property. So how long is it going to take you to make your money back on this property? You're never going to make your money back on this property. Ever going to make your money back on this property. So that's complete loser. So that's quick calculation, quick looking at it. You already know you're not going to make money. You're looking at the estimated payment just by looking at Zillow. Estimated payment $5,500, and you look at the rental income and how much is renting property around there, how much they rent out for. You're losing on it. And then if you look at the property itself, I mean, it's not exactly as fancy, and it probably not even going to rent out that much. It's not going to rent out for $2,500. It might not even rent out for $2,000. So you're going to lose even more. Let's go look at the next property. That's a property I talked about, actually close to our neighborhood, where I talked about the real estate lawyer who bought this property, and she purchased it for. She's selling it for $340,000. She purchased it for, I think, around $320,000. So her note is about $250,000. So we're talking about $2,500-ish payment on that property. She had, back when I looked at that property, obviously she hadn't sold it yet, and I looked at it, I think, like last year. Hadn't sold it yet. Wonder why. But she had only 2 units rented out, $650 a unit. So that's $1,300 is what she had coming in from that property, and she's paying $2,500. She's losing $1,200. It seems like, from what I looked at, she rented out all of them right now, so maybe she's breaking even. Great, she's breaking even, but that's not counting the fact that utilities maybe she has to pay for. Actually, no, I looked it up. She has to pay for everything except electric, so the tenants are paying electric. So your yard maintenance, maintenance for the house and everything, and maybe I'm assuming there's gas and stuff like that, and trash and water and sewer. You still have to pay for that. That's still going to be an extra expenses that that this individual did not look into. So you're losing money already. So even at breaking even of having all 4 units rented out, and basically just breaking even right there, you got to consider the fact that there's maintenance. You got to consider the fact that there's yard maintenance, there's a house maintenance, there's utilities that you have to pay, the water bills, and everything else. So you're losing money on this property. That's why this person can't sell this thing. Plus all the expenses that has to go on this property. Let's look at another one. Hot market, Miami, Florida. Okay, this property, $700,000, $1,200. I want to call it a shed, but small house. $1,200, 1,200 square foot duplex. Duplex. So that means every unit is 600 square foot. Okay, $700,000. All right. So your rental on that, at the most, is about $2,000 a unit, which is crazy high for this little property that needs a lot of updates from what it looks like. We'll get to the updates here in a second. But let's say you get lucky and you rent out each one of them for $2,000. $4,000 you have coming in, right? But your payment on that is $4,400. $4,400. Again, you're losing $400 a month on the property. And that's, again, not counting all the utilities, maintenance, and everything else. And it looks like this thing needs a lot of work. I mean, it needs a lot of work. Just the outside looks horrible from what it looks like. The inside, I don't even know how it looks like on the inside. The outside looks horrible. By God. You're losing money. It's a no-brainer. You don't have to go through the formulas and everything else. You just look at the market. You look at the fact that the maximum you can probably get on that is $2,000. So $4,000 for 2 units, $4,000, and you're losing on it, $400 a month, guaranteed. It's a guaranteed loser. You go to the next property right away. You go to the next property. You don't have to look at formulas or something like that. Like old YouTubers, like, oh, that's all you have to do. It's basic math. It really is just basic math. So let's look at this market right there. It's closer to us, and there are a lot of markets right now where you can actually still make money, and they actually does not depreciate. Actually, still appreciating. Properties are appreciating even right now because of how cheap they are and how much money you can make on those. So this property right here, it's a triplex, 3 doors, $130,000. Somebody bought that property for a couple years ago, so it's appreciated already. Regardless, it's not appreciate something crazy like in California or something, or in Austin or Miami, or it didn't appreciate that much. But mathematically, let's look at it this way: it's a triplex, $130,000. Your note on that is $752 a month, right? $752 a month. You are gonna rent out in this property at the worst at about $700. Worst, you're gonna rent it out at $700 a month. So mathematically, 3 units, $700 a month. That's $2,100, right? $2,100 versus $752. That's a ding, 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 ding. At that point, what does that tell you? You're gonna make some money on that property. You can make some concrete calculation of how much utility is going to be and everything else, but you can clearly understand the $2,100 and $752 with what your payment would be versus what your income is going to be from that property. Clearly, there's quite a bit of a spread, so obviously you're going to make some money on it. Again, you don't need no formulas. All you have to do is look at 2 different numbers: what your payment is going to be and how much income is going to bring to you. It's as simple as that. And we can look at a lot of those properties. I just touched on it. I really touched on just a bunch of properties just like that. And it's that simple. It's that simple. There's not a mathematical complicated formula you have to follow or something else like that. It's just basic math, guys. It's basic math. Like, follow, subscribe. If you guys like this kind of content, show me a property. Show me a property. I would love to look over it. I would love to look over it. It's basic numbers. We can delve into it more concrete numbers, but it really is that simple. Your return on investment and investing like that is kind of that simple. It's just math. Like, comment, subscribe, guys.